banking awareness, and our topic here it is qualitative credit control and legal framework of RBI, and we are continuing with these two topics. First, when we say that it is qualitative credit control, and we are discussing on behalf of RBI. So, the functions of RBI, Reserve Bank of India, and other banks. Then, first term is marginal requirement. So, in definition, we will say it is current value of security offered for a loan. That is marginal requirement. So in simple words, if we want to understand this, so if we want to have a loan of 1 lakh rupees, then we have to put a security. Suppose let it is rupees 2 lakh rupees. So then that means that is the current value of security offered for a loan, and we have to mortgage the security. That is, mortgage means गिरवी रखना, गिरवी रख दी, कोई property रख दी, gold or any FD etc., fixed deposit etc. Insurance, even if we can take loan on by mortgaging our insurance, LIC, life insurance, like that. Then second is rationing of credit. That comes rationing. So here we take it like that, maximum limit of the loan. So here we have taken 1 lakh for 2 lakh security, this much security. So maximum limit of loan advance and advances that can be made made by a commercial bank. So it is for particular cases, speculative cases, like that government wants certain reforms in agriculture sector. For that they want, government wants to give loans, easy loans. Then what it does, it for this security it goes up to a loan of 1,50,000 for particular cases, not always. That maximum limit that a loan can be provided. So it is rationing of credit, but this limit is fixed by RBI. It is fixed. So this is a fake minimum of capital. Now in this way, what is capital total asset? Fake of minimum of capital total asset, that is ratio of capital and total asset that can be prescribed. It is prescribed by RBI. So in first case it was 1 lakh rupees, and government bank has 1 lakh rupees with itself capital of, because total capital is 2 lakh. Out of that 2 lakh, 1 lakh is given to the person and 1 lakh is with bank. So 1 lakh divided by 2 lakh, it is 1 by 2. But in second case, total is 2 lakh, but bank has kept only 50,000. So it is 50,000. So how much it will be? 1 by 4, that is 0.25. It is 0.5. So it is the fake of minimum of capital total asset that is prescribed by the RBI. So that maximum you can come up to 0.25, 0.3, whatever it is. So it is prescribed by RBI. Then after that we come to legal framework of RBI, Reserve Bank of India. So first, the acts administered by RBI. First it is. Now first act, it is RBI Act, and we have also discussed it in further. First act is RBI, under which it is Reserve Bank of India Act 1934. it is for the formation of RBI. Formation of, so under this act RBI was formed. Then Public Debt Act 1944, Public Government Securities Act 2006, and we have discussed in our economics class what is public debt. Public debt means that loan taken by government of India. So Government Securities Act 2007, Banking Regulation Act 1949, Foreign Exchange Management Act 1999. It is also known as FEMA. And we will discuss further what is FEMA. So it is FEMA, Foreign Exchange Management Act. Then Securitization and Reconstruction of Financial Assets and Enforcement of Security Act 2002. Then Credit Information Company Regulation Act 2005, Payment and Settlement Act 2007, and it was amended in 2008, then 2015, and Factoring Regulation Act 2011. So we have noted these things. Now, because we are studying it under the topic of awareness, that means we need not to go further. Okay, so we need not to go what the legal aspect of these laws, but in awareness we should know that what are the terms which are used here and what are the meanings of these terms. If we are knowing that what is foreign exchange, what is banking regulation, what is security, what is debt, what is financial asset. Okay, what is financial asset? Securities, cash, gold, etc., property, etc., whatever it is. Then second act is other relevant acts. One is Negotiable Instrument Act 1881, and second was Bankers Book Evidence Act 1891. So these acts are still going on. These are not we can say obsoleted. Why? Because either these should be amended. If there is a certain flaw in these acts, these should be amended, or otherwise they will go on as it is, whether it was British government or it is a Indian government. Because banking system does not mean that now you have changed your government, now the acts will go on. No. Then State Bank of India Act 1955, and we have discussed that before making of before 1955, State Bank of India was known as Imperial Bank of India, and it was formed by clubbing three banks: Bank of Bengal, Bank of Madras, and Bank of Mumbai. And after that, in 1955, it was Imperial Bank of India was nationalized. Now it is known as State Bank of India. Then Companies Act 1956, 2013, Security Contract Act 1956, State Bank of India Subsidiary Banks Act 1959, and here we have discussed this. It is DICGC. We have discussed it as the subsidiary of RBI. So, Deposit Insurance and Credit Guarantee Corporation Act 1961. Under this act, our deposits are insured up to rupees 1 lakh. And after that, Banking Companies Acquisition and Transfer of Undertakings Act 1970. Then further it is in 1980. Regional Rural Banks 1976. Now from here we can have the economic issues of that time. because to face the economic issues, we have to amend or expand our banking system accordingly. So here that means there must be a certain economic issue that government has decided or RBI decided or government has decided to expand the banking sector in rural areas, rural banks. Similarly, National Bank of Agriculture and Rural Development 1981. So it comes after the Green Revolution. National Housing Bank Act 1987, and we have studied it as a subsidiary of RBI. Then Recovery of Debt Due to Banks and Financial Institution Act 1993. So there is a provision for recovering of debts. Then Indian Coinage Act 2011 governs currency and coins, and it is also a function of a liability of RBI to govern all these things. Banking Security Act, for this we will discuss what is the year later on. Then Industrial Development Bank, Transfer of Undertakings and Repeal Act 2003. Industrial Finance Corporation, Transfer of Undertaking and Repeal Act 1993. So there are certain financial liars in finance that deal with companies or CAs. For these things, they are studying these things, these laws in detail, but we are taking here only in general awareness. And then some important acts under RBI. So first act that we have discussed here, RBI Act 1934. So Reserve Bank of India Act 1934, it was passed in Indian British government, in Indian Parliament, that was under Britain at that moment. So it was for the formation of RBI, and there is a provision that this body RBI will supervise the banking firms in India at that moment. Then there was a division of Indian banking regions. One is Western area, it is governed from Mumbai. Eastern area, Bengal. Northern area, Madras, and northern area, Delhi. Southern area, Madras. So in this way, we can say that it is the division of Indian banking regions. So, okay. So up to this we have discussed. Yes.